So the Fed isn't in the habit of surprising markets, but after what happened last week with the RBA and BoC, you can expect both traders and investors to be on their toes with what's to come this week. Hello, everyone. Monty here, market analyst at IGUE. And as always, let's go ahead and get started with some of the recent events. Now, I know the RBA, Reserve Bank of Australia, and the Bank of Canada, that was a clear surprise. We spoke about it last week in the sense that it was sort of between hawkish hold versus dovish hike. The way it felt, especially one after the other, felt like it was more like a hawkish hike. We got rate hikes out of both central banks, and that kind of tilted the narrative or got people thinking about, okay, isn't there the possibility that the Fed therefore might start to raise rates as well and get a little bit more hawkish? That's not what markets are pricing in. We're going to get to that. And I also want to point out that when it comes to the Fed, a lot of times they're very, very much about their style, that is, about telegraphing to the markets, letting them know ahead of time. A little bit, if you want to think about it, it's kind of like planning a wedding. Nobody wants surprises versus a surprise party out of the RBA and BoC. That's kind of the difference between the two of them in this regard. So I don't think anyone should look at and think that the Fed is in the habit or that it's part of their style to try and surprise the markets and surprise the world, given the U.S. dollar's reserve currency status. And we're in a pre-meeting blackout period, so we're not getting anything but basically, long story short, just to go over some of the data that we saw late last week, initial claims, a bit of a miss there, higher than expected, at highs unseen since, if you take out the revisions, highs unseen since 2021. Continues though as a beat, and we're still in this phase where we're getting, every time there's some positive data, it's coming out with some negative weak points. Every time there's some negative news, usually there's some positive going with it. So it's this mixed report, both devil and angel on your shoulder. Tech didn't outperform. I'm just going to pull up IG's trading platform over here and look at US Tech 100. Bit higher, this futures pointing higher. It didn't outperform, especially compared to the S&P and the Dow, and more so when it comes to small and mid-cap, Russell 2000, S&P 400. But the S&P 400 is in a bull market, so congratulations, I want to say, to the S&P 500 on getting there. However, I kind of want to give my condolences to the majority of the companies in the S&P 500, given that it's pretty much been led by the Magnificent Seven. The so-called Magnificent Seven was Apple, Alphabet, Amazon, Microsoft, Meta, NVIDIA, and Tesla. So that's kind of been the concern. Even there, like when we're seeing a rise in terms of the stock market, you kind of see the bond market is screaming recession. Stock market seems to be doing okay, at least on the surface. So there's still these weak points. We're in this contradictory phase, let's call it that, in terms of what we're seeing in terms of data, in terms of what we're seeing when it comes to the markets, and yes, when it comes to central bank policy, which we're about to get to. ETF, by the way, I'm referring there to regional banking ETFs, positive finish, still a mountain to climb to get back to pre-SVB levels. And when it comes to market pricing, in terms of what the Fed is expected to do, this is pre-CPI, because we got CPI on Tuesday, and that's the decider. We're in this phase where, yeah, the Fed doesn't want to surprise the markets, but they made it very clear. It's down to the data. If inflation continues to remain hot, or I should say that if it's hotter than expected, and there are further bumps when it comes to this disinflationary path, then naturally they're going to have to react accordingly. So far, though, expectations pre-CPI, so before Tuesday, 4:30 p.m. our time, before the release, markets are pointing to a lack of an increase via majority from a rate hike when it comes to the Fed on their Wednesday announcement, but that there's going to be an increase, again, pricing via majority, courtesy of Refinitiv, that's going to be in July. So we're looking at a skip. So it's not pause and then cut, it's more skipping until the July meeting, and that's what it's pricing in so far, but the door is open for both meetings, for a hike in June and for the lack thereof when it comes to July. The doors, they've kind of kept the door, it's not a fully priced in move, it's via majority with a significant minority available in both cases. When it comes to CPI, of course, this is going to be released on Tuesday, Fed starts their meeting, and then afterwards they're going to announce their policy Wednesday, our time Wednesday night. But for May, the figures for May, Consumer Price Index, expecting the headline month-on-month growth of 0.2, some putting estimates at 0.3%. Year-on-year is going to drop from 4.9 to 4.2, 4.1%. And at the core, and this is obviously the sticky core of the problem, if you will, the problem child, month-on-month at 0.4%. Now, if it's stronger than that, it's much more likely markets are going to start to price in a rate hike this Wednesday instead of in July. And if core comes out in line with expectations, or maybe even lighter, but headline comes out stronger, then that means that it might open the path to a stronger or more bullish dot plot, which might price in another, and that just means that rate hike pricing for July is going to obviously increase more. Let's just say by a bigger majority, the likelihood that we're going to see a rate hike out of the U.S. Federal Reserve then. Of course, when it comes to the revisions, GDP and core PCE likely to be higher, unemployment slightly lower from their estimates last time. What about when it comes to the European Central Bank? That's going to be on Thursday. And technically, when it comes to the Eurozone, we're seeing a bunch of stuff that pretty much points to what would normally be softer central bank policy had it not been for higher inflation, I should say, especially when it comes to its core. Technical recession, inflation headline is dropping, but core is still high, and consumer inflation expectation coming down, according to the ECB survey. So pretty much in line with that, but overall, we're still looking at fully priced in, again, courtesy of Refinitiv, last I checked, 25 basis point rate hike priced in. That's going to take the deposit rate to 3.5%. So no one, that would be, let's just say, no one's expecting anything different from that. I don't expect a big move based on that. What really matters, though, is that markets, by a majority, they're pricing that there's going to be another rate hike, 25 basis point rate hike in July. So a lot of, and people are all wondering what's going to happen beyond that. Even if ECB, like the Fed, we're talking about a data-dependent phase here. So, and more so when it comes to pricing, when it comes to the ECB, given their mandate. But that means that a lot of people are just going to be looking at hints in terms of, okay, what lies beyond that? Are we looking at further rate hikes beyond July, in September? Is the possibility of a potential rate cut, as markets have been trying to price at times, and some, ECB members coming back and pushing back against that narrative. And of course, there are projections when it comes to the Eurozone, even if in the current phase, they've said it themselves, that the projections don't carry as much weight, just because they're really reacting a lot to the data. It doesn't mean that they're going to ignore the projections. It doesn't mean the markets are going to ignore it. It just means they got to look at the data quite a bit. And when it comes to the Bank of Japan, that's on Friday morning. No changes expected. Key rate's going to stay at negative 0.1%. Yield curve control going to stay in place. Let's just say so far that when it comes to the Japanese government bond market, the 10-year yield, it hasn't been testing the Bank of Japan's upper band. It's been below 50. It's been behaving itself as of late. And you also have to add the fact that household spending, the latest figure year on year, negative 4.4%. Shinto wage talks, those disappointed. There were wage gains overall year on year, but they're down in real terms, and that just means it's not really providing much fuel in terms of the Bank of Japan. It doesn't mean that they might not open the door to an increase when it comes to their pricing projections. It just means they'll likely just stick to the narrative. Although keep in mind that the impact of any surprise, if the bank, I'm not saying it's going to happen this Friday, but if there ever were to be a surprise out of the Bank of Japan, the impact globally when it comes to global bond markets would be enormous. Anyhow, for those of you wondering, we've got the weekly market report. It's in the link in the description, by the way. All these things that I've mentioned, or pretty much all of it's going to be here, and a whole lot more, as well as looking through, the different products that are available, FX, commodities, gold and oil. We got Bitcoin and the 6 indices. So that's about it from our end. I want to thank you guys so much for joining us, and happy ticks.